So, Aninda, becoming more defensive, where exactly are you putting money to work at the moment in this environment?
Well, still in defensive sectors. I may sound like a broken record now, but we're still looking at value over growth, high dividend, low PE parts of the market, which, have, albeit not done terribly well in the last 1 month or so, but still have outperformed riskier parts of the market where PE ratios are still high. And the discount factor from real rates is rising, has risen very rapidly, and continues to pressure risk assets. And aside from that, the only other two... Yeah, sorry, go ahead.
No, please continue.
I was going to say the two shifts we've made recently is to begin suggesting reducing underweights in fixed income, given the degree to which rates have already risen, and several of your other people you've interviewed this morning have also pointed out the inversion or the flattening of the curve, which has been materializing over the last few sessions.
Yes, indeed. Jay Powell becoming increasingly in the majority with his view that a recession is not inevitable. I know you're one of the people who thinks that a recession more likely than not. But of course, not all recessions are created equal, are they? How deep and enduring do you imagine it would be?
Well, clearly the risks have risen. Financial conditions are tightening. The energy price shock, the cost of living crisis, if you will, is particularly hitting Europe and the UK quite hard, and it is showing up in the US as well. But all said and done, it's not inevitable just yet, although the risks have risen. But that being said, again, the way we are expressing that view is by continuing to be defensive, even while understanding that you don't have a situation of a sell-off in equities and a sell-off in rates for more than 1 or 2 quarters in a row. At some point, something has to give. And which is why we are suggesting reducing underweights in the rate space at the moment, but not quite going long duration yet, because as you were highlighting, Jay Powell is still pointing out that inflation is hardening. The work we've done internally at BNY Mellon shows that of the 8.6% inflation print we saw most recently, 3.6% or 40% of that is demand driven. So that goes to show that, demand side inflation is a serious problem. And that's what I think Jay Powell's highlighting as well. So we're not yet convinced that it's time to go to long duration. But I think, reducing the underweight in the fixed income space makes a bit more sense.
So, Aninda, when it comes to turning defensive, that doesn't necessarily include China, although you seem to be liking or at least disliking it less, the Chinese equity space. What does turning neutral mean for you? Do you get in? Are you long in the space?
Well, we're suggesting being neutral with a tilt in specific areas such as technology, such as consumer staples, and infrastructure. I think these are the 3 key areas which will benefit the most from a sequential improvement in growth in China in the coming 1 or 2 quarters. That the reason we are not long equities yet in the China space is because, structurally, I think the zero COVID strategy still persists. And the property market continues to exert a downward pressure on the market. But for now, I think, if you look around the world, which other major economy is going to give you positive growth in the next 1 or 2 quarters? A pickup in growth in the next 1 or 2 quarters is a better way of putting it. And I can't see too many other places aside from China. Which is why, we are suggesting, turning less bearish on China, going neutral, and with a focus on tech. Somebody's got to employ all the graduates that are coming out of the universities in the next few weeks. And I think the restrictions on tech are easing, and you can see that play out. Infrastructure is a favorite sector. That's what's driving the stimulus. And consumer staples, at some point when the restrictions the lockdowns ease, we're already seeing some pickup in consumption spending. Yeah.
So if you're seeing the economic momentum shifting from the USA towards China, where you're actually expecting some sort of growth, does that mean also all of the economies and markets heavily dependent on China also have more potential for upside?
Yes, which is why we're a bit more constructive on Southeast Asia in particular. They're less open, at least the ASEAN 5 countries, barring Singapore, are less open to overall growth in the global economy. And a bit more linked. They have gotten more linked to China over the years. So I think insofar as you get a China upturn and a reduction of upside inflation pressure. Keep in mind, we're also seeing producer prices come off. The prices of metals, copper, and so on have come off quite a bit. So those kind of things will alleviate some of the upstream pressures you're seeing. At the same time, you're going to see a downstream or a pickup, a sequential pickup in demand out of China, which helps the rest of the region out.